Australia has stunned the world's financial community with a decision that almost no one could have anticipated. In a historic move, Fortescue, one of the largest iron ore producers on the planet, bypassed Wall Street entirely and secured close to $2 billion in financing directly in Chinese yuan. The deal's conditions were so favorable they resembled the kind of rates governments typically enjoy. Not long after, Australia's Treasury issued its first ever bond denominated in yuan, while the Reserve Bank quietly shifted roughly 1/4 of its foreign currency reserves into China's renminbi. The IMF described the move as without precedent, pointing out that no advanced Western economy had ever repositioned itself so quickly toward China's financial orbit. With one of America's closest allies now raising funds in Beijing's currency, a profound question emerges. How long can the US dollar continue to anchor global trade before its dominance starts to fracture? The chain of events that led here reads like a turning point in economic history. In August 2025, Fortescue announced a syndicated loan package worth 14.2 billion yuan, around $1.28 billion USD, arranged by the Bank of China and ICBC. According to Reuters, it marked the first time any Australian company had ever borrowed such a large amount directly in Chinese currency. Even more remarkable was the price. The interest rate was locked at 3.88%, nearly indistinguishable from Australia's own 5-year government bond yield of 3.67%. For a private firm with no ability to print money or raise taxes, securing such state-level terms was nothing short of extraordinary. Fortescue later confirmed it had achieved the lowest cost of borrowing in its entire history. This did not happen in isolation. Earlier that year, in February 2025, the company had voiced unease about its $550 million hydrogen venture in Arizona, citing confusion and instability in U.S. regulatory policy. By midsummer, the project was abandoned entirely, forcing Fortescue to take a $150 million loss. The Wall Street Journal interpreted the retreat as evidence of investor frustration with Washington's inconsistent energy framework. Having lost confidence in the U.S. market, Fortescue pivoted toward the steadier environment offered by China, a shift that seems, in retrospect, inevitable. Beijing already absorbs over 80% of Australia's iron ore exports, according to official data from June 2025. By borrowing in yuan, Fortescue effectively synchronized its debts with its revenues, eliminating most currency exchange risks. The Financial Times later disclosed that the loan was tied to Fortescue's push into green steel, including a $400 million order for heavy electric machinery from the Chinese industrial firm XCMG. What's emerging is a deeper pattern. China is transforming from Australia's top customer into its key lender, supplier, and strategic economic partner. The aftershocks are being felt throughout Australia's banking system. In August, regulators quietly modified domestic lending rules to allow joint yuan-denominated loans between Chinese and Australian institutions, a technical change that enabled the Fortescue deal and opened the door for more. Analysts warn that if other corporations follow suit, it could gradually chip away at the dollar's long-standing dominance in Australian finance. Statistics already hint at this direction. On September 1, 2025, the Australian Bureau of Statistics revealed that 14% of all exports to China were now billed in yuan, up from just 3% a year earlier. The IMF's assessment a day later projected that, if the trend continues, Australia could reduce its dollar-based reserves by roughly $20 billion per year, cutting transaction costs and reshaping the Reserve Bank's balance sheet in the process. Financial infrastructure is quickly catching up. In June 2025, ANZ launched dedicated yuan clearing for its corporate clients, granting Australian businesses direct access to Chinese currency transactions. Simultaneously, the People's Bank of China introduced sharply discounted clearing fees, 0.05% for yuan deals compared with 0.25% for US dollar settlements, a clear incentive to speed up adoption. For companies managing billions in trade, those savings are impossible to ignore. One senior mining executive told the Financial Times that pricing contracts in yuan cuts volatility and ends dependence on American financiers. Taken together, these developments signal something far more significant than a few corporate loans. Australia's leading industrial players are no longer merely selling resources to China. They're embedding themselves inside its financial network, testing whether Beijing can take over as their primary banker, supplier, and long-term partner. And that realignment is now mirrored by the state itself. According to the Reserve Bank's September bulletin, yuan assets now make up 25% of Australia's foreign currency reserves, a 5-fold jump from just 5% in mid-2024. Such a dramatic shift in barely a year is virtually unheard of among developed nations. What began as a single corporate financing decision has evolved into a nationwide recalibration of economic strategy. one that could prove irreversible. The IMF's September report sent ripples across financial capitals from Tokyo to Singapore. Central banks throughout Asia are increasing their yuan holdings by nearly 40% year-on-year. Yet, while most nations are cautiously diversifying, Australia appears to be racing ahead, reshaping its financial identity in real time. It's not merely hedging against the dollar. It's constructing a new framework centered on China's currency. When a close U.S. ally multiplies its yuan reserves fivefold in under 2 years, the debate isn't about whether this shift is happening. It's about how quickly the world's financial order is beginning to change. Australia's latest financial maneuvers have sent quiet tremors through Washington and the global markets alike. Beneath the headlines lies a deeper question. Has Australia just stepped too far from America's financial orbit? Analysts at the Lowy Institute think so. In a paper released on September 2nd, they cautioned that by diversifying its reserves too aggressively, Canberra might be undermining its own access to the US dollar safety nets that once acted as a financial lifeline during crises. The message was clear. What used to be unshakable support from the Federal Reserve may no longer be something Australia can count on. Officials in Canberra insist this isn't a political statement but a financial safeguard, a form of insurance, not allegiance. But Washington isn't convinced. Inside the corridors of US power, this move is being read very differently. A leaked diplomatic cable obtained by the Financial Times on September 3rd revealed growing unease within US agencies monitoring yuan-denominated bond activity in Sydney. Their language was anything but neutral. To them, this isn't simple diversification. It's a potential pivot, one that touches the core of both economic and strategic trust. While Washington debates intent, Australia is already reshaping its financial DNA. The Australian Prudential Regulation Authority recently opened consultations on allowing domestic banks to hold yuan clearing accounts, a quiet but historic step toward embedding the Chinese currency inside its banking system. In the same week, the $250 billion Future Fund announced plans to allocate up to 10% of its portfolio in yuan starting next fiscal year. The country's largest superannuation fund followed by launching a yuan-denominated infrastructure debt program tied to projects under China's Belt and Road Initiative and green energy developments. This is no small gesture. It's a fundamental shift in how national capital is managed. Trade flows tell the same story. The Australian Foreign Investment Review Board confirmed that in just the first half of 2025, 80% of Chinese direct investment into Australia was already settled in yuan, with inflows up 12% from the year before. Currency data from Bloomberg showed daily AUD-CNY trades doubling to $2 billion per day by late August. During that same period, AUD-USD volatility dropped 15%, signaling that global traders are recalibrating to a system where the yuan now acts as a stabilizing force once reserved for the dollar. The impact on Australia's balance sheet has been immediate. Government budget papers released September 1st estimated that borrowing in yuan helped cut national debt servicing costs by around $200 million AUD in 2025. Real savings, not theoretical ones. And the private sector is racing to catch up. On September 3rd, an Australian investment firm announced it would issue its first yuan-denominated green bond in early 2026, inviting investors from Sydney to Hong Kong. By the end of August, the People's Bank of China reported that yuan-based trade between the two nations had already crossed $50 billion in the first 7 months of the year, surpassing the total for all of 2022. The momentum isn't slowing, it's accelerating. Fortescue's yuan loan was never a one-off headline. It was the first domino in a sweeping transformation now playing out across boardrooms, ports, pension funds, and trading floors. The bigger question dividing economists is whether this is clever risk management or a slow surrender of financial independence. But while experts argue, Australia's exporters are already moving ahead. The Port of Newcastle, the country's largest coal export hub, completed its first yuan-settled shipment to Guangdong in early September, worth 820 million AUD. Port officials described the transaction as smoother, faster, and cheaper than traditional dollar settlements. Just days later, BHP signed a memorandum with the Bank of China to explore yuan financing for upcoming copper projects, a move aligned with forecasts of rising Chinese demand in 2026. These aren't minor experiments. They're global industry leaders rewiring their funding toward Beijing. Markets are evolving in response. The Australian Stock Exchange will begin listing yuan-denominated bonds in October 2025, allowing companies to raise funds directly from Chinese investors without routing through US dollars. Globally, yuan bond issuance jumped 34% in the first half of 2025 compared with the previous year, and Australia has emerged as the most critical new front in this expansion, according to the Financial Times. Policy is catching up quickly. On September 4th, The Australian Treasury made history by incorporating Yuan borrowing into its official sovereign funding strategy, a first for any non-dollar debt in the nation's history. The IMF now projects that if Canberra continues at this pace, its US dollar reserves could fall below 40% within 2 years, making it one of the most diversified economies in the developed world. But beyond the numbers lies a bigger question. Once the yuan becomes this deeply rooted in Australia's financial system, can the US dollar ever reclaim the ground it's losing? Over $50 billion worth of trade settled in yuan in just 7 months, a milestone that once took years. The trend is no longer hypothetical, it's unfolding in real time. If this trajectory continues, the issue isn't whether the dollar's dominance will fade, it's how soon the yuan will replace it as the default currency in Australia's trade and finance. This isn't speculation anymore. It's a live shift, a quiet, unstoppable transformation redefining how nations borrow, trade, and build alliances. The architecture of global finance is being rewritten before our eyes, and Australia is standing right at the fault line where old power meets the new. Thanks for watching. Don't forget to like, share, and subscribe for more global analysis.